Evening, guys. How you doing? Okay, let's test this out. Let's just make sure that this is actually going to work. So, please let me know if in the section box I'm coming through clearly or whether I'm not. Because the last time I just want to make sure that we get this absolutely spot on. We don't have to stop and start again. How you doing, Javin? Good to see you, mate. So, hopefully this is going to stream well. Sounds all good. That's great, mate. Thank you very much. I'm just a little mindful of latency here, so on and so forth. But I think we'll carry on as we do, and guys, give me feedback as we go through this. But yeah, I'm looking forward to taking some questions from you guys this evening. A lot has happened over the last sort of week, particularly when it comes to kind of like the markets and stuff. So I'm sure that many of you who follow me here for the investment content may have some questions specifically around the markets and what's been going on currently. So as more and more people trickle in, we will get into the questions and go from there. You guys are going to start noticing a few things that are going to change on the channel ever so slightly. There's a few things that I do want to introduce in the coming weeks, and that's going to be happening gradually. Just in terms of a change to the look and feel, there is a membership package that I'm looking at introducing fairly shortly, which will have like a load of other perks and stuff like that. And one of the things that I'm looking at actually throwing into this membership perk is actually my investment course. So my investment course is $99.99. It's 4 chapters, 15 lessons. On one of the tiers, I'm actually going to throw that in as part of a membership perk as well. So there's a lot that I'm working on in the background, but it should be fun. So as you guys roll in, please do feel free to throw any questions that you have in, and we can go from there. I'm just making sure that everything's set up here properly on my side. I did test this earlier, but oftentimes when you do this, you never really know until you're literally in the thick of things. So I'm just making sure that everything's here is fine, and then fire away. So I don't know if many of you have actually noticed, but the videos are now 2 a week, and there's a reason for that. First and foremost, I want to kind of make sure that I can drive a little bit more traffic to the channel. As you guys know, it is within my plans to basically move to Dubai in a couple of years' time, and YouTube does form a big part of that. So yeah, 2 times a week now, and I'm probably going to be doing a little bit more around kind of like the behind the scenes type stuff. I'm involved with quite a few projects externally now, and so with that, what I also want to do is just kind of get you guys involved, and so that you can see what's going on in the background in terms of what I'm working on. And these projects are all projects that will help you guys as well, because they're all financial literacy related, and they are very, very core to my beliefs in doing this on YouTube, and the reason why I'm here on YouTube doing this kind of stuff, and on obviously Instagram on the podcast as well. So as I'm doing these things, you're going to get the updates through as I kind of shoot them. I've got to start looking at trying to get an external videographer. One thing I've learned is that I can't do everything myself, so trying to lighten that workload is really, really important as well. So I've got a friend who does a little bit of videography work, but I'm in the Midlands, he's in London, so we need to work out that logistically to see how we're going to get this working properly. But yeah, it should be really, really cool to see where we go. So guys, feel free to let rip with the questions if you have them, and I'm sure we will get through them really, really quickly here. Okay, Javin, you've got one here. I've just opened up a Starling account, which I know you use. I've got a normal high street bank too. I love the bank, but don't want to miss out on interest from any nationwide accounts. Any suggestions? You can have more than one account, mate. So oftentimes, I mean, the high street banks, interest rates are pretty low at the moment anyway, period, across the board. So if your main concern is basically trying to get, the best interest rates possible, there's no reason why you can't have 2 or 3 bank accounts. You're not going to get penalized for that at all, mate. So I know I used to work for Nationwide when I first started years and years and years ago. And oftentimes they do have some really good accounts because they're a building society. They're not a PLC like NatWest and RBS and Lloyds and these guys. So they are very much still kind of like the way they're set up is very, very different. Like they're I can't remember the term for it now, but they're run for the benefit of their members, so the benefit of their account holders essentially. So if you think that you can get good interest rates on instant access for your accounts with Nationwide, there's no reason why you can't keep that account open. You're not going to get penalized for it, so it is something that you can do and will not be frowned upon. And again, it might be a good house for things like your emergency fund and so on and so forth. So yeah, no reason why you can't have 2, mate. So let me know, guys, if you have any questions in here. I know that I did a very, very brief live. Hey, Byzantium. Oh, dude, that's an awesome name. Oh, I love that. It sounds like I love that. I love that. Absolutely love that. So, right. Okay, a question, if I may. Do you think investment trusts are preferable over open-ended funds? Do you see any drawbacks about trusts? I don't often see investment trusts mentioned on YouTube. Well, investment trusts, right, so with open-ended investment companies, effectively, they are open-ended investment companies, right? So they're companies set up to invest in the markets on an open-ended basis. So you're invested and you don't have an end date at all. They are the most common ones that are often used and spoken about because of all the flexibilities and stuff like that, right? Now, with an investment trust is set up differently because it's essentially a trust. If you don't know what a trust is basically kind of like, it's an account that is set up with certain rules by the people who set it up, and you have trustees who are in charge of the trust. So within an investment trust, they are mandated to, number one, make sure that the investments are run according to the mandate of the trust itself. So it may have a mandate to say, right, okay, this will be a medium risk investment, and they will have guidelines. Now, with that being said, because the trustees are responsible for the performance of the trust and they have to invest it responsibly, then it basically means that you have things like investment managers who will be held accountable and stuff like that. They are a good vehicle. I mean, there's no reason why you can't use an investment trust, but oftentimes open-ended investment companies, or OICs as they're called, are the ones that are kind of like preferred and more popular. That's why you're probably not hearing it much on YouTube, and you've got to think about the cost as well. So oftentimes on YouTube you're going to hear collectives and funds like that because they are low cost. With an investment trust, you're going to have higher cost because you've got trustees looking after who are responsible for making sure that the investment is run according to the mandate. So oftentimes if you're looking at first time investors particularly, then you are definitely going to be looking at collectives mainly as the main port of conversation, or index funds, because they're a basket of the top markets in the world, be that FTSE 100 or Dow Jones or S&P 500 basically, and you can access these funds at a relatively low cost, whereas with an investment trust you're going to have slightly more cost involved with using it. So it really depends on your level and where you are at the moment, whether you're kind of a sophisticated investor, then you might find investment houses using that, or a financial advisor might use one for you, but most of the time because of the cost they're going low with a collective or an index or something like that to keep the cost down. Hope that answers the question, Buzz Auntie, and if not, let me know. There is one here from Chantel. Hi Pete, my question is around the Financial Services Compensation Scheme. Limit of 85,000. We all talk about the power of compounding over time, but when your ISA meets that limit, what do you suggest people do? Want my savings to be safe but fully benefit from years of compounding interest? Okay, so if you've watched some of my reviews on here, you would have noticed that I've pointed out a couple of times that some providers will give you cover under the Financial Services Compensation Scheme with no upper limit. Now the standard is £85,000, some companies will give you that protection with no upper limit. What that basically means is that if you have 200,000, 300,000, the financial services compensation scheme will still cover you. At least they're going to pay a little bit extra in order to make sure that your holdings are fully covered with them. Now, not that many companies actually offer that. There is one that I know of, which is a pension provider. They're called Pension B. They have financial service compensation scheme with no upper limits. It doesn't matter how much you have. But to answer your question, if you do get to the point where you have invested money and your investments through interest and investment returns go over the £85,000, then what you can do is you can start thinking about how you split it across providers or institutions, right? So for example, if you've got money with Moneybox, for example, then you could decide that the minute you cross over that £85,000, assuming they're not giving you any protection with upper limits, which I don't think Moneybox do, then you might decide that you want to transfer or at least move a portion of your money into another provider like Wealthify. Now you have to be careful with how you do that, because obviously you've got ISA rules in terms of the contributions. So you need to be really, really careful with how you basically do that. I certainly know that, you know, being in the industry for a long time, that is a valid question that a lot of clients ask. However, I think it's really important as well just to bear in mind that this is where the financial strength of the bank or the institution that you use is really, really important. So if you're with a bank, for example, let's just say you've got your ISA with HSBC, then I'd be looking at them and thinking, right, how much do they actually have in terms of financial security? Are they likely to go bust? That's when those kind of things really come into play. And it's really just doing your homework and making sure that you feel comfortable with the company that you have your money with, to have that comfort in knowing that, you know what, if I go over my £85,000, is this company likely to go bust? If the answer to that is no, which is why it's always good to use some of the big boys, but the big boys are very old fashioned now. So financial security, financial stability is very, very important. And it's the reason why a lot of the times when I start talking about the providers that I reviewed, Wealthify for me is top of my list, purely because Wealthify as a business is actually supported by Aviva. They have a parent company called Aviva, and is it Aviva? I think it's Aviva. I'm pretty sure it's Aviva. I need to double check that actually. I'm pretty sure it's Aviva, but they've had like £1.5 billion in the bank in cash in Q3 2019. That's really, really important. More cash in the bank means more financial resources, more financial stability, and scenarios where, you know, COVID comes along and wrecks people's accounts. So that's really, really important. I hope that's answered that question. I know it's a little bit of a long-winded one, but if you're worried, think about moving it across to different providers. You can do that. You need to be mindful of the ISA contribution rules and how you're going to do that. So what you might do is you might have to do it as a transfer, but you just need to be careful of that. But again, just research the companies, make sure they are strong from a financial standing, and you should be okay. Let me know if you have any follow-ups to that, Chantel. Okay, so Daniel, dude, how you doing, mate? Good. Right, okay. What you got here? If I was to own an ETF, do the companies in the ETF change or company percentage change over the years, or are they fixed? Well, with an ETF allows you to, the basic fundamental ability of an ETF is for them to be able to trade and change those stocks on a daily basis, right? So if you want a fixed allocation portfolio, then you're better off probably not going with an ETF, because an ETF is designed to be able to be traded on a daily basis, and it gives a bit more fluidity and the ability to swap in and out of equities or stocks at any given time. So with an ETF, they could change on a daily basis. I mean, are you looking for a fixed portfolio in your construction? Because that will determine where you go. I mean, ETFs are great because they're liquid and they allow you to trade pretty much almost on a daily basis if you needed to. I would really suggest that you read the fund fact sheets for whatever ETF that you're buying. Just make sure that you read the detail of what the ETF is designed to do, and likely how often they're going to be trading, if they're going to be trading. But if it's an ETF, I would imagine they will. I don't know. You'd have to double check, because it depends on how the ETF is built and who it's built by and what their remit is, what their mandate is. Javin, with interest rates being so low at the moment, how would you suggest growing your money best? I'm already doing a bit of investing on trading 212 and saving every month. Mate, really, really hard right now. If you want to grow money, the best place to grow money is really by investing. How you invest it is the other question, though. So do you use all equities, so trading 212? Do you use bonds? What do you use? It's really down to what your objectives are going to be. And again, this is where I come back and talk about goals. What are your goals? What do you need to make? And trading 212 is great, right? So obviously I've got stocks within trading 212, but it's really, really important as well, Javin, that you just don't use that as your sole vehicle to invest in the hunt for better returns on your money, because at the end of the day, you are only using one investment basket. That's it. You're only using equities, and the risk in that is pretty high. I mean, you just need to look at this week and look at the Dow. Like, stocks took a plummeting over the last couple of days. So if you've got all of your money in trading 212, and you've bought tech stock specifically. I mean, tech stock on my trading 212 on Friday and Thursday, all the stock that I watch and own were down. Every single one of them. It was just a sea of red. So you need to be mindful of where you're putting your money and making sure that you're using all of your investment baskets as possible. And what I mean by that is not just it's using equities, it's using bonds, it's using property. And I don't mean residential property. These are property, as in commercial properties built within an investment portfolio. It's using gold and commodities and things like that. So you need to understand how you're going to do that based on your goal. But low interest rates right now, you're not going to get much in a bank, period. So the only way you can do that is to look towards the markets. But the question will be, how much risk are you able and willing to take in order to get the returns that you want? So again, what is your goal? Are you looking at, you want to get 4%, 3%, 5%? What is it exactly? You need to know that. But it's really important that you use all of the investment baskets that are available, because each of them will have different risk ratings, that each of them will do different jobs, and that's why you would have them in an investment portfolio in different measures, because that's what they're designed to do. They're designed to fulfill specific roles when you look at your objectives. So, and again, this is all in my investment course as well. Mo, is Alibaba undervalued? I'm not following that stock right now, mate, so I wouldn't be able to tell you. But with that being said, I mean, Alibaba, they're huge. I mean, right, let me just have a look and see what their stock price is right now. 1 second. What is the stock price of Alibaba right now? It's not one that I'm following at this point in time. Let's have a look. I think what you're probably trying to get at there, Mo, is this a good time for you to buy? And it really depends on what the Chinese economy has been like, because obviously these guys are really, really big, certainly in the Chinese market, and for people who are doing, drop shipping and stuff like that. Most of that stuff comes from Alibaba. So it's hard to ascertain and determine, right, okay, the stock is going to be undervalued without actually doing some proper analysis. But just looking at the stock charts at this point in time, I mean, at this moment, it's at $281, and it's been on an upward trend for the last it's been on an upward trend for just coming up a year now. I mean, this time last year, so I can go back to, where can I go back to? I can go back to the 19th of September, it's $177. Right now it's $281. So, I mean, it's been on an upward trend. Yes, it's been volatile in between, but with these sorts of things, you need to have a look at what they actually do, who's using them. You think about COVID, people are looking to set up side hustles. How much of an impact or benefit does someone like Alibaba actually add to that? Now, drop shipping is great, but with Alibaba, because it's coming out of China, delivery times, all that kind of stuff need to be considered. But how many people are actually using them? I mean, just looking at their financials, are they actually in profit? Let's have a look. Market cap 761 billion, profit ratio is 28.39%. So earnings per share just under $10 earnings per share. So from a financial point of view, let's see if I can get more of this. 1 second. 20 profit margin, yeah. Net income, revenue, net income 149 billion. Total assets 1.3 trillion assets. Total liabilities 548 billion. So that, you know, they're not highly leveraged as well for a business. I mean, they're 41.77% leveraged. And, you know, we're talking big numbers here, but ultimately they've got more assets than they have liabilities, and they're actually in profit as well. So are they undervalued is going to be a matter of, yes, you need to do the analysis on here, but ultimately it's going to be depending on where do you think that business is going to go overall. Do you think that it's going to add value to your portfolio if you were to invest in it, or do you think that actually, you know what, it might be a bit bumpy and you don't want to take that punt? Whatever stock you buy, you have to have some kind of conviction around what you believe the company is going to be worth in the future. You have to, because otherwise, why are you buying it? And I know it's really important to get in at the right time, but then oftentimes you have this danger that you're trying to time the market rather than just be in it, right? And that's really, really important. So, you know, do the research. I mean, looking at the numbers very high level there, they look pretty healthy, they look pretty good. But the question is, where do you think they're going to go? Do you think that they're going to be a business that's going to be worth more money in 12 months' time? If that is the answer, then you should be buying. If it isn't, then stay away from it. But let your decision be made from a place of, right, you understand what the company basically does. That's what I would say is best. But just looking at the numbers right there, it looks really, really good. So, yeah. All right, what have we got else here? If you do have a follow-up question on that, Mo, just let me know. I'm planning to open an ISA Vanguard account for more substantial amounts. My portfolio held up well despite hard week. I own various companies as well as ETFs. So it sounds like you're diversified, mate. You haven't got all your money in, you know, tech stock, which is great. And that's the whole point. That is the whole point of diversification, so that if tech takes a hammering, other things are doing really, really well. So important not to put all your eggs in one basket. So, and again, mate, Javin, at the end of the day, like, if your portfolio is growing over time, a couple of days of a downturn makes no difference whatsoever. It's inconsequential. But the idea is you've got different things doing different jobs, and overall it's delivering you some kind of positive return. That's the most important thing. I'm also looking at, here we go. There's follow-up from you, Javin, on here. I'm also looking at getting Wealthify integration with my starting account so that I can invest small amounts too. I didn't know they were doing that. Are they? Interesting. I might have to have a look into that. That's something I've learned this evening. Cheers for that, mate. Okay. Real Talk Dre. What's the best broker to use that's available in the UK? When you say broker, what do you mean? Do you mean traditional stockbroker, or are you looking at Trading 212 and the like? If you're looking at someone like Trading 212, there's Trading 212, there's Free Trade, there's eToro. I've not reviewed Revolut yet, so I need to do that still. They all have different things that they do really, really well. So one thing so I did a eToro review this week, right? So one thing that eToro does really, really well is they provide you with some really good information, a little bit more information than actually Trading 212 offer you. Whereas with Free Trade, I find that they don't really give you much at all. So you need to be doing your research elsewhere if you're going to be using Free Trade to buy stocks, because you need that basic information. So all the information that I've just looked up about Alibaba on Trading 212, I've used Trading 212 for that. You won't find any of that on Free Trade. So you'll need to do your research elsewhere in order to get that information. But for me, for the time being, I would say Free Trade. If that's what you mean by a broker, Free Trade is a really, really good one. But I do like elements of what eToro does in terms of the information and the research they show you. and I need to do a review on Revolut because I heard that they're really really good as well, and obviously they have accounts as well, so you can tag on investments from the accounts, kind of like what Javin was suggesting there with Starling, and do it all in one place, and also heard currency accounts as well apparently, but I need to review those guys in the coming weeks. So I hope that answers the question, Real Talk Dre. Let's see what else we've got here. Okay, yeah, I was thinking about owning an ETF fund for clean energy on Trading 212 and wondering if that one changes the companies in the index fund like an active fund. Right, okay. I wouldn't confuse an ETF with an active fund, mate. I wouldn't confuse an ETF with an active fund. So an ETF basically allows you to get access to some great companies in a basket at relatively low cost, not as cheap as like an index or a collective, but allows you to trade almost on a daily basis if need be. Now with an active fund will be completely different, because with an active fund, you are going to be giving your money to somebody else to manage, which will be an investment house or a fund manager of some kind. And they will be making active decisions on when they decide to readjust, rebalance, buy new stock, profit take. They make those decisions. They could almost make it on a daily basis, although for all the ones that I've ever worked for, they've never done that. They say that they do, or they could, but I've never ever seen them take action on a daily basis unless the world's going to shit. Then they'll make some real drastic moves if they need to. So active funds are more expensive as well, mate. They are, because you're employing professionals to look after your money. Oftentimes with an active fund, they'll have regular meetings, they'll have a chat, but they'll have their own asset allocation, they'll have their own strategic asset allocation and their own tactical asset allocation, which is how your money is spread across different companies that they'll be running by and be stringently be working along those guidelines. So ETFs are very, very different to actively managed funds. Very, very different to actively managed funds. DJ, let's go. Okay, hey mate. Have I heard of Lansadia Holdings? Thinking of going big on them because of their upcoming merger. I've not heard of them, mate. I don't know what they do. So I can't really comment. I'm just gonna have a look and see if I can find any information on them here. Lansadia Holdings. They're US based. See, there's no data. Not even in Trading 212, so I wouldn't be able to tell you, mate. I've not heard of them. Right, my advice to you would be this. Make sure you do. If you can't have the information here in Trading 212, try and see if you can find any. Go to their company website, find out as much information as you possibly can, and basically just try and get a feel for what market they're serving, all that kind of stuff, because I think that would be really, really important. But I don't know about them. I've never come across them, and at the moment there is no information on them at all in Trading 212 for me to be able to give you kind of like a quick recce of what my thoughts are. The marketplace, Javin. Okay, so Mo, I'm using them for my Amazon businesses, and a lot of Amazon sellers are using them to Shopify. Yeah, dropshipping, eBay. Yeah, AliExpress is popular in three world countries. But like you said, I need to look more. Yeah, I mean, look, I know for a fact that they are massive when it comes to the whole Amazon FBA, the drop shipping and stuff like that. I mean, look, that's where you're getting most of the products at a margin that makes it worthwhile for you to make money, right? You try and get it from the UK, Europe, or even the US. There's very, very thin margins left for you to make any money at all. And with that being said, and because the internet is such a wonderful place for people to build businesses, they have access to the Chinese market, and they have facilities really to make that whole dropshipping, cycle really, really easy. So they are really, really big. I do think though that because of the pandemic and COVID-19, it will be interesting to see what happens over the winter months if there is a second spike. If countries do start going into lockdown, because bottom line is people need and are looking to, start side hustles. So, and if you look at here on YouTube, Amazon FBA drop shipping is all the rage and has been for a very, very long time. But yeah, you just need to have a look and see what they're doing as a business. Are they innovating? Are they bringing anything new out that might mean that they're attracting more people, or the company might spike in value? And also with Alibaba, there's so much stuff that they do as well. So it's not just about that; it's also about the wider company as well. Right, what have we got here? Okay, there's a few that are coming through. All right, okay, so we've got one here from Len. Are there fees attached when one transfers their stocks and shares ISA to another broker, i.e. Moneybox, Fidelity, Vanguard? No, there shouldn't be any fees at all attached to those. I don't know anyone who charges a transfer fee if you're going from one provider to another, but ask the question, because stranger things have happened, but I've never heard of one, and there shouldn't be any fees attached for the transfer. Right, Benjamin. In our 30s, looking to invest some of our savings for the long term. We have a separate emergency fund put away already. Would it be better to go trading 212, for example, a Wealthify investment ISA? Okay, Benjamin, you know what? You're killing it, because you've already got an emergency fund, which is, you're winning right there, mate. Because that's the foundation. Now that you've got an emergency fund, you can now actually start looking at putting money into the stock market and investing properly without having the fear of, I might need this money at some point in time. So with your investment horizon being 30, well, you're only 30, so your investment timeline should be pretty healthy. I don't know whether you're planning to buy a home, but one thing I would, think about at this stage is, what is your goal? Why are you looking to invest? Are you investing because you want to buy a house in a few years' time? Are you investing for the long term? What is your goal? Why are you investing? You need to understand that. With that said, though, and in direct answer to your question, if you are a first timer, no experience whatsoever, if you don't want to spend time researching companies, looking at balance sheets, looking at what they do, looking at the share prices, all that kind of stuff, then you're better off going with someone like Wealthify. I'm a firm believer. 99% of first-time investors are going to be better off giving their money to someone like Moneybox, Wealthify, Fidelity, Vanguard, or someone like that to invest for them, basically just to build that confidence of how things work. If you don't, and you go straight into trading 212, believe me, it can be a huge learning curve. And you really need to think about what happens when you go and buy 10 stocks and all of them are down in one day. You can see that on your phone. You start to freak out. Are you going to start freaking out? At least if you manage it with somebody, they are not just going to be using equities and buying just stocks in companies as your main investment holding. They're also going to be using things like bonds. They're going to be using things like property, commercial property, to diversify your risk. Risk management is really, really important. I can't overstate this enough. So depending on where you are, Benjamin, depending on whether you're experienced or complete newbie, complete first-time investor, I would steer you towards someone like Wealthify and let them do that for you, and just try and get an understanding of the language that they use, how they build a portfolio, how they explain risk, all those kind of things, and use that to build confidence into trading 212. Because trading 212, you're making all the decisions yourself, and you have to know what you're doing. Again, I cover all of that in my investment course. I talk about the 4 asset classes. So the main 4 popular ones that people use are equity, property, bonds, and cash. Yes, only a little bit of cash to facilitate trading and things like that. So it's really, really, really important that you kind of use that as a gauge. But yeah, if you're a complete newbie, go and give it to someone to manage for you. That will be the easiest, and it will take away a lot of stress if you don't like seeing your money go down in value, and don't want to be asked with doing all the research and checking things on a consistent basis. Any follow-up questions on that, Benjamin, just let me know. If you have any questions as well, just feel free to message me on IG or something like that as well. Crimson Bride, how you doing? Welcome. Ralph the Raptor, what made you want to start Conversation of Money channel and page? Mate, I've been in the industry for 15 years, and I explain this on the podcast, but I'll just go over it here now. I've been in the industry for 15 years, and growing up, my parents are like poor, dirt poor. I had no financial education, no financial literacy. I literally came back to this country when I was like 18. I had 50 quid in my pocket, didn't even understand money, didn't understand anything. Like literally, I was bouncing checks until I was probably 28, really, really bad with money. Somehow, I found myself in financial services. I got a job in a building society, and I kind of like worked my way through the business and kind of started to learn what credit cards are and overdrafts and why your credit report is really, really important. But I learned by being in the industry, and watching people as well, meeting wealthy people and being like, oh, that's very nice. You've got all this money in the account, and learning how they basically do it and how they leverage and use money. Then later on, when I started working in Canary Wharf, I was doing really, really well, earning six figures, and because I didn't have any financial literacy, even though I'd been in the industry at that point for probably about 7 years, I just did what everybody would do when you don't have any money growing up. You just go and spend money on just stupid shit. And it was an epiphany and a conversation I had with a friend of mine, a colleague at the time. He was talking about he had a house in Devon, and I'm like, well, I know you got a flat here in London, mate, so how have you got like a holiday home in Devon that you're going to this weekend? And he's like, oh yeah, I just move my money around. And I'm like, we earn the same amount of money, so like, how can you have like a property in Devon that you're going to, which is your holiday home, and you're flat in London, and there's me, and at the time I was probably wearing £1,000 suit, thinking I'm the G, and then like having nothing. And that kind of sparked a bit of a fire in me, thinking, actually, you know what, you need to do something different. And then, I qualified as a financial advisor, started working with really wealthy people, started to see what they were doing. And I remember at the time, I was like, I really want to do some financial education stuff and work with younger people and kind of like share my experiences and, share some of the stuff that I picked up. And I was told, well, if you focus on that, you're never going to get rich. And that stuck with me. That happened 4 years ago now. And it's been in the back of my mind ever since. I started Instagram in January 2019. So it'll be 2 years. No, 2018, sorry. So it'll be 2 years that I've been on social media come January. And it's really just to kind of like show people what I've learned, teach people what I've learned. And coming onto YouTube, I only did this in January, basically. So I'm here to kind of just share my knowledge and stuff like that and try and help people not make the mistakes that I've made. I've made some really stupid mistakes. I had an epiphany very, very late in life. I earned a load of money, spent a load of money. I could have invested that money and done so much better. So if I can, share my experiences and my expertise and the things that I've learned in, videos and lives like this and all the other stuff that I'm doing, then that will be good for me. And if I can build a business out of it, even better. But that's why I'm here, mate. That's why I started the channel. That's why I started the page. That's why I started the podcast. And it's just an extension of what I'm really passionate about. And hopefully I can change something, because the financial services industry doesn't really give a shit about, the age group 25 to 45, because they're deemed to have no money. They're all after the 50 plus who have tons of money, and they're neglecting of the fact that there is a need in this space. And I see it really, really clear. I hope that at some point they'll also see it, but I'm going to do as much as I can to kind of like change that perception and change their outlooks on this. So that's why I started. I know that's a bit of a long-winded story, but that is the truth. Have you got some advice for new immigrants to the UK and how to improve their credit rating? Yeah, so where you coming from, mate? The first thing is, look, just set up with a basic account first and foremost, because if you're new to the UK, you're gonna be starting with a clean slate, so like zero basically, right? So get yourself an account. Initially, you're probably not going to get an account that's going to give you like a debit card and overdraft facilities and stuff like that. So get yourself just a normal account, get some money running through that account. Then, after about 6 months or so, 6 months to 12 months, you want to start asking a question and just seeing if you're pre-approved for things like overdrafts, because the banks will pre-approve you based on how much money you have coming into your account and whether the shape of your expenditure leaves you additional money in the account. So for example, if you're earning like £1,000, are you spending all the £1,000, or are you good enough in knowing that £1,000 comes in, but by the time you roll around to your next payday, you've still got £300 left in there? All these things count, mate. So what you want to do is open a clean account. If you haven't got any facilities, start to manage your account. Get money running through it. Make sure you have the management of it right. Make sure there's some money left over in your account by the time you next get paid. And 6 to 12 months, you want to start asking whether you can have an overdraft. A lot of the banks will pre-approve you for an overdraft. If you're lucky enough to get an overdraft, then start to use that. But don't use up to the full limit and then have pay go in and then reduce it and you're using it constantly. Keep it there. Use a little bit every single month, pay it off. Let them know that you're okay with just, borrowing money and they're going to get their money back. From there, you can then have a look at getting a starter credit card. And again, with the credit cards, I always say this to people, there is a misconception that if you have a credit card, you should use it and then just pay it down little by little every single month. That's the worst thing you can do. No. So if you get a credit card with, say, 500 quid as a limit, you don't want to use all 500 quid. That's the worst thing you can do. What you want to do is you want to use something like £150, £100, right? Pay that off in full every single month. Just doing that on a consistent basis is going to help you build credit. You also need to think about making sure that you get on the electoral roll, so council tax. Make sure you're registered for where you live, your address where you live, if you're able to do that, and make sure that if you're able to get things like your gas, your electric in your name, get those in your name as well, because all those things feed into your credit score. So those are just a few things that you can do straight away to help you. But yeah, if you have any questions, just let me know and follow up, and find me on IG as well. Right, okay, GD, hi, watched your beginners investing video last night. I'm 20 years old and opened a stocks and shares ISA and general investment account, GIA. I opted for the high risk adventurous option on both as I'm young. Would you? Yes, I would. Advice otherwise? Would I advise otherwise? Look, mate, you're 20 years old. You've got a massive, massive, massive time horizon. I think it's really, really important though, again, I've said this a number of times on this live already, try to get an understanding of why you're investing. So you're 20. Are you going to be looking to purchase a property at some point in the future? I'm guessing that you are, if you're not already a property owner. I'm guessing that you are. It's really important to understand, right, when is that likely to be in the future? Is that going to be in, 5 years' time, 3 years' time? Where does that money that you're investing now come into that picture? Are you going to need it for a deposit? So for example, if you're opening a stocks and shares ISA, is it going into a lifetime ISA? Really, really clear question. If it is, then you need to kind of make sure that that risk that you've taken going really, really high, adventurous, is proportionate to when you're going to need the money. So on my investment course, I talk a lot about investment time horizon, the timeline that you're investing over. And logic tells you that if you're investing for the longer term, so this is 10 years plus, you can afford to take more risk. If you're investing for less time than that, then you should be taking less risk. So in your circumstance, and I can't give you direct advice because I don't know your full circumstances, these are a couple of things that I would be thinking about. First and foremost, if you're going to be buying a property, when is that going to be? Is it going to be in the next 5 to 10 years? If the answer is yes, then you're likely going to need that money. So you need to ask yourself the question, are you comfortable taking really, really high risk with your investment? If the answer to that is no, with the knowledge that you're going to need that money for a deposit, then you probably need to ratchet back. If you're not going to be looking at buying a property, or you're okay, then if your investment is 10 years plus, then yeah, high risk could be really, really good for you. But those are questions that only you can answer. I can't give you advice again because I don't know your personal circumstances. I do consult with people one-on-one. But those are just a few pointers. In terms of the risk thing, again, the investment course covers all of this. It gives you the foundation that you basically need to understand how you position. And on that specific topic in the chapters, I actually give you a checklist as well, because there's a pre-investment checklist that is really, really important that you make sure that you're ticking off the list to make sure that you're fully ready. But those are just a couple of things for you to consider. Benjamin, have I just lost that? 1 second. Let me just go back up. Sorry, 1 second, guys. Okay, here we go. What are your questions? Newbies to investors looking to put. Okay, so here we go. Let me just read this message. So thanks, man. Answered all our questions. Newbies to investing, looking to put away for house and future kids' schooling. Right, okay, cool. Benjamin, you really need to think about the risk levels that you're basically taking. And also, really, really important for you, really, really, really important, you're talking about your kids' schooling in the future. You need to have a clear idea of what that's going to be so you can start planning for a specific amount. So when I was a financial advisor, what we'd do is we'd be sitting down with someone like you, Benjamin. So we'd sit down with you and your partner, and we were looking at, right, okay, so if we had a plan for your life over the next 10 years, what does it look like? So at what point are you going to need the school fees for the kids? What is that number going to be? And then based on that number, we will be working backwards to say, right, you need to be investing this much and aiming for this return in order to meet that objective. And what we'll then be doing is on a yearly basis, we'll be reviewing where you are to ensure that you're on track to meet that specific goal. Now, I don't know what you do, but mate, find me on IG and we can talk a little bit there. But yeah, if you're going to put it with Wealthify, absolutely. But you still need to bear in mind those other little things as well in terms of working back exactly what you need to be putting away now in order to meet that goal of school fees for your kids, and obviously putting away for a house, because those are really big milestones. So working towards a milestone is what financial advisors do, and what I do in my consultancy business now is I help people work towards these milestones. So find me on IG and we can have a little chat there. Tom Walker, how do you remain realistic about what you're meant to or supposed to be saving? I'm trying to save about £400 per month plus anything extra. Okay, Tom, great question, mate. So this is what I would be doing, right? And this is what I have done, and it's worked for me in the past and still currently works for me now. Always give yourself room. All right, don't target yourself for something that may be a little bit unrealistic. So the first thing you need to do is sit down, get your bank statements, get everything that you've got going out. So all of your bills, council tax, rent, all that kind of stuff, write everything down. Write down all of your subscriptions, Netflix, Spotify, Disney, whatever it is that you're paying for. Write them all down. Make sure you've got them in one place, total all of them up. Then have a look at how much you got coming in. Then deduct your outgoings from what you've got coming in and come to a number. Now, oftentimes what people do is they'll say, right, I've got £2,000 coming in, my bills are 1,500, I'm going to save 500 quid. It's not going to happen, mate, because guess what? You're going to want to go out with mates and go out for dinner and do the things that you want to do, and that's really, really important. My biggest thing when I'm coaching clients is I talk about balance. There is no point in putting away 400 quid if it deprives you from doing the things that you want to do. And it could be little things like gym memberships, right? It could be little things like that. So it's really, really important that you get balance. So if your disposable income is 500 quid, allocate some money for the things that you want to do. So you know that at least you've got some kind of enjoyment from you going to work and doing all this stuff. Then whatever's left, commit that into an investment plan. You're more likely to stick to that than doing it just by saying it's going to be 400 quid and you having to sacrifice things that might be a little bit painful. Again, that is something that has really, really worked for me. So I call it bucketing, and it's basically having one bucket for your, the stuff that you have to pay for: rent, gas, electric, cars, all that kind of stuff, right? Then having a discretionary pot, which is, right, I like going to the cinema, I like going to the gym, I like going out once or twice a month for food with my mates. You have to allocate money for that. Anything else that is left over is what you then put into investments. So that's what I would suggest for you, Tom, just to make it more realistic. And I know that it's worked for me, so hopefully it will work for you. GD, there is a follow-up question on there, as in different risk level. All right, okay, cool. So who did you say you've gone with in the end? Let me just go back up quickly, mate. One sec. Okay, you haven't said who you've gone with, but if you're with a provider, so again, risk levels and your investment levels, most of the providers will only have three. They'll have like cautious, medium, cautious, moderate, and adventurous, right? So if you're adventurous, which is top of the scale right now, you might want to have a look at what the others mean, which means you're going to be pegging back. And it means that your investment portfolio is going to be built slightly differently, because with the adventurous, you're going to have a lot of equities. If you go moderate, you're going to have less equities, probably more bonds because it gives you more stability, more security. Whereas with cautious, you're going to have very, 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 very little equity, probably more bonds and more property. So you'll need to check with your provider who you've got just to see what other risk levels they have. But you're right at the top of the scale, mate. So you just need to see what other ones they have as you scale back. Daniel, thanks for your help, Pete. Just out of interest, did you start investing into the stock market yourself? Yes. My investments are in collectors, and I'm using Trading 212 and Hargreaves Lansdown. So yeah, I'm invested in the market still now. Have been for a while now as well. Paul Colden, looking to invest 50k plus in an investment fund for long-term early retirement growth income. Looking at either Wealthify, Nutmeg or AJ Bell. Favouring AJ Bell because of their low fees. What is your opinion? AJ Bell's very, 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 very good at what they basically do. They're one of the more established big boys in the field. One thing I would suggest is have a look at the fee structure. How much are they charging? So on and so forth. And when you say you're looking to put it into retirement growth and income, I would be asking the question of how you're going to pay this money in, Paul. Because if you are looking to invest for retirement, as you're saying, then the best way for you to invest that money, because you're going to be getting free money whilst you're doing it, and because if you're saying you don't need it, then it's going to be for retirement income, is to put that in via a pension. So you may be self-employed. I don't know. I'm guessing you might be. If you are, then you need to have a look at a pension. Your pension is limited by how much you earn, though, because the maximum you can put in is £40,000. So you have to be earning £40,000 per year to put in £40,000. That is the cap. But because you got 50, you can put a large amount into your pensions. Really, I'm sure you've done a little bit of research, mate, but I'm just giving you a few things to think about there. With a pension, you're going to get a huge amount of tax relief going in. You're going to get 25% extra from the government for that 50k that you were paying into, 40k that you're paying to a pension. So it's really worthwhile thinking about that, mate. Really, really worthwhile thinking about that. If you need any help, find me on IG, and we can have a little chat there. But AJ Bell are very, very good. They're more experienced and more established than Wealthify and Nutmeg. But I'll have a look at their costs, their fees, and what they're offering as well. Let's have a look. DJ, one more question. I'm a student, so I don't have a proper income apart from loans I get. What things should I be doing now in terms of investing, etc.? I can reap the benefits in 10 to 30 years plus. Thanks. One of the first things you can do, mate, is put it into an ISA. That will be the best way for you to start. It will be tax-free. At least you're not going to be paying any money to the tax man. And if it is invested, all your returns are going to be tax-free as well. So that'd be the first place that I'll be, saying that you put money into. Ideally, you really want to have an emergency fund. But if you're a student, the question will be: are you going to need this money? And that's the whole thing. The reason why an emergency fund is so important is that you'd never want to invest money into the markets. Then something happens, you need the money, but the markets have taken a hit like they have done Thursday, Friday this week, and then you face the possibility that you're going to have to cash in your money and take a loss. An emergency fund is there to protect you for that. So really, you do need to have a little bit of an emergency fund in place. But then again, you may be getting help from parents. If your parents are helping you, you just want to start investing straight off the bat to kind of get yourself started, which is a great thing anyway. I'd really strongly encourage it. Then definitely go into things like an ISA because it'll be tax free. All right, Nathan. Hi P. PayPal Credit offers 0% interest for 4 months on purchases over £100. In this instance, if I pay the minimum balance and then the full balance on the final month before interest is due, would this negatively affect my credit score? What limit are they giving you on the PayPal credit card, mate? So there is a thing called credit utilization, and credit utilization is really the thing that's going to hurt you. So for example, if they give you, so the general rule of thumb is that you really want to be in between 20 to 30% of your credit utilization or your credit limit, right? So for example, if their limit is £1,000, they're giving you a PayPal credit card with £1,000, right? Then you ideally want to be using between £200 and £300 per month. Now, If you use that and you only pay down the minimum amounts interest free, that's fine because it's not costing you anything. It's not going to negatively affect you if you don't do because number one, you're using less of your credit utilization over a period of time. Making the minimum payments is fine because overall credit utilization is going to be pretty low. If it was the opposite way around where you've got £1,000 using the full £1,000 and you're only making the minimum payments, that is definitely going to hurt you because not only are you using full credit utilization, you're only making minimum payments. But in your example, if it is £100, you make the minimum payments and you pay out the full amount before the interest is due, that's fine. There shouldn't really be that much of an impact on your credit score at all. Nikos, okay, hello. May I ask if you would trust online brokers for a long time? I'm currently using Trading 212. I'm pleased, however, I hesitate to build a capital in it and keep it there for many years. I would always say to people to always have a variety of accounts that they basically use. I mean, with Trading 212, I mean, look, they are great because you've got access to the fact that, you can buy stocks, commission free. That's really, really great. And, you are covered under the Financial Services Compensation Scheme with them, which is great. And they are regulated and authorized by the Financial Conduct Authority, which is great. Whether you trust them long term is really going to be down to your own preference. So a lot of people are very uneasy with Trading 212 because of the whole Bulgarian connection, the fact that the company was built, started out in Bulgaria and they are registered in Bulgaria. So a lot of people are not very comfortable with them for that reason. It will be down to personal preference. I would just say, just bear in mind that you've got the Financial Services Compensation Scheme there. If they go bust, 85 grand, you're covered. You've got to go through the rigmarole of actually claiming it back, but you will be covered. It's going to be down to personal preference, mate. But me, personally, I use Hargreaves Lansdown, I use Trading 212, and I definitely have other investments elsewhere. I don't just use one provider, and I think that's something that is worthwhile everybody bearing in mind. Daniel, when did I start? I probably started about 5 years ago, properly investing big time. So yeah, because that's when I had my epiphany. Well, it's about 5 years ago. I had my epiphany when I was like 34, 35, after that conversation with my colleague in Canary Wharf about his house in Devon. Very, very shocking moment, I must say. There you go. What else have we got here? Nikos, what happens to the deposit on an online broker investor if a company is delisted or bankrupts? Right, so if a company goes bankrupt, then you should be covered under the Financial Services Compensation Scheme. If it's delisted though, if it's delisted because they've broken the rules, then the Financial Services Compensation Scheme will not kick in for that, as far as I'm aware. So if they're delisted because they've broken the rules, the Financial Services Compensation Scheme will not kick in for that. It will kick in if they go bankrupt. So if they're delisted, which is again why you really need to do your research on the companies. Look, let's put it this way. A lot of the companies who get authorized by the Financial Conduct Authority, they have to jump through hoops, and it's very, very expensive to get a license. I mean, these licenses cost like £100,000. I mean, the application process is horrendous, right? So if there is an active broker right now that has got authorization from the FCA, believe me, they would be stupid to do something that gets them delisted. Now, bankruptcy is a completely different thing because that's all about how the business is basically run. But to be delisted and have their licenses pulled, then trust me, it's very, very, very unlikely that would happen for a company. They wouldn't go through all of that rigmarole to get their license just for them to do something stupid. Although it does happen, I haven't seen it happen a lot, but if they get delisted, I don't think the Financial Services Compensation Scheme will count. For bankruptcy, it will. For insolvency, it will, but not for delisted. So again, it's all about the research and making sure you're comfortable. Nathan, mate, thank you so much for sending that in. I really, really do appreciate it. That super sticker there is going to help me massively, and putting the time into these kind of things, it really does show. So I really do appreciate that, Nathan. Thank you very, very much. Nicole's got one more thing. So last question, if it's okay with you, I personally consider pharmaceuticals a great sector to invest in for the long term. Do you agree, or do you have any other suggestions? Look, at the end of the day, think about the world and think about life, right? What are the things that people cherish the most? Health is one of them. It is at the top of everybody's agenda, right? If you're unhealthy, you've got an illness, you can't really enjoy life. So pharmaceuticals is a great sector for me, because they are actively working to improve people's lives and what they do in life. It's, without health, you can't do anything. You can't go on holiday, you can't work, you can't do much, right? So pharmaceuticals are great. And a lot of the big pharmaceuticals, obviously with COVID now, are hard at work trying to solve a problem that we all need a solution to. And, you know, it's a great sector. So pharmaceuticals, absolutely. The important thing is, if you're going to be picking a sector or a company, you need to have a look at sectors that are doing things that are essential to life, right? So consumers like McDonald's, Coca-Cola, all those kind of like sectors, really, really important. Energy. People need energy. People need electricity. People need water. People need these things. So those kind of sectors that are essential to what we do on a daily basis, is really, really important. So if you're looking for sectors, you look for those, you know, necessities specifically, and then you try and look at who are the top companies or who are the challenger companies within that sector, to have a look at, you know, who you might want to invest in if you're using Trading 212 and looking to pick, you know, these kind of stocks yourself. Right, let's see what else we've got here. Where's my mouse? There it is. Burford Mad Dog. Right, okay. Serious question. Is there a broker in the UK with customer care that doesn't suck? I checked Trustpilot. That's funny, mate. I checked Trustpilot and the reviews are abysmal. AJ Bale, IG. You know what, mate? I'll tell you something that funny that happened this week to me, right? So I've got Tesla stock, yeah, and my Tesla stock is with Hargreaves Lansdown. Now the split happened like this Monday. It took Hargreaves Lansdown 3 days for them to actually administer the additional shares, and they've done it incorrectly as well, right? So bearing in mind that I've done a load of Tesla videos on this channel, right, and talked about Tesla specifically, and the fact that they were doing 5-1. I mean, it went over to like $2,000. It came in at $440 after the split, went up to $499 like 2 days after the split actually, you know, happened, and it was trading on the new stock price. So there's me thinking, okay, I might take some profits now because the stock's done pretty good. I'm up 125%, I think it was, or something like that. I want to take some profits. Looking at my Hargreaves Lansdown account, and it's like they've not administered the additional shares. And I'm like, what the hell is going on? It took them 3 days to do that. So, mate, I feel your pain when it comes to customer services and things like that sucking, because a lot of them are absolute garbage. They really, really, really are. And one of the things that really does annoy me these days is the fact that, you know, a lot of the time, because everything is on your phone, it is very, very hard to actually get on the phone to actually speak to somebody. Like, come on. Like Hargreaves Lansdown, they hid the number. So I literally Google Hargreaves Lansdown telephone number to actually get the number. You couldn't find it on the app. And a lot of these companies are like this now, because on your phone you can do so much, but if you're old school like me, or you have those tendencies like me where you don't want to speak to a person, then yeah, sometimes it can be very, very difficult indeed. But I feel your pain on that one, mate. Trustpilot's always a good one in terms of reviews, but one thing I would say as well is that, you know, sometimes it is worthwhile bearing in mind that we are human beings, right? We will always complain when we have a bad experience, not necessarily when we have a good one, because we don't find the time to give a really good review. So take it with a pinch of salt. Like, people do have bad experiences, no doubt, but more people are likely to complain than they are to praise a provider, specifically when it comes to money, because money is very, very emotive. And like, literally, I looked at the Hargreaves Lansdown reviews over the Tesla stock split, and there was just tons of them. They're late, I'm gonna sue, and I'm like, okay. But having spoken with them, the reason why they couldn't administer them quickly, and this is the contrast to Trading 212, the Apple split, because I've also got Apple stock, that happened, it landed with the new splits literally on Monday. So it's like, there's Trading 212 is relatively new, There's Hargreaves Lansdown, who's been around for years, fully established, and they can't do what Trading 212 are doing. And this is based on, you know, the fact that they have been around for such a while and they've got old archaic systems that they don't want to invest money to go and change. And I had a conversation with a person that I spoke to over the phone. It's just, it's one of those things, mate. But yeah, I feel your pain. I really do feel your pain. Daniel, this delisting I think is planned for Intech Pharma on the Nasdaq as not meeting the $1 minimum for November 2020. What's your thoughts on this big sell-off? That's my last question. All the best. Right, Dan, as you know, I was looking at Intech Pharma and I didn't buy because I was looking at the price, and I looked at it at 44 cents or something like that, and it's just gone down and down and down and down and down, and I didn't buy. And I was looking I was waiting for some further information about how their trials with Alzheimer's have been going, because they were entering a different phase. So I wanted to actually have some additional results before I put any money in. But again, it's really important to know these things when you're buying stocks, because at the end of the day, you know, these companies are very, very attractive. But if they are at a risk of being delisted, then trust me, people are going to be getting out. People will be getting out very, very quickly. So if you bought, it might be a time for you to look at where you are and look and see what news is out there at the moment, whether there's any developments that might turn it around. I know that they do a lot of stuff, at least I've seen a lot of videos from their head CEO or something like that on YouTube. So yeah, just try and dig around for some information on the American markets and see if there's anything that they've got that might turn them around, that might turn it around. Okay, so what do we got here? I think we're pretty much all there. Thanks for sharing. Some brokers can't deal with profit and loss calculations after a split. That's very, very true, mate. That is very, very true. Okay, cool. So we've covered quite a few questions there. I do appreciate you guys for dialing in. And again, thank you for Nathan, mate. That's really, really, really appreciate donating there and showing some support for the channel. Thank you so much. I'll probably hang on for a few more if there are any more. But if not, the next video is going to be out on Tuesday. If there's anything you guys want me to kind of like cover in terms of topics, then please do let me know. There's a lot of stuff, like I said at the beginning of this live, that I'm looking to kind of like adapt and change on the channel. There's a few things I'm going to be interested in introducing as well, including something that is going to give you guys access to the investment course as part of a membership thing as well. But I've got a lot of stuff I still need to do with that before it's available to launch. But I talk about the investment course because it really will give you guys the grounding and the understanding of how the world of investment works, how investments are built, how risk comes into it, how you stack the odds in your favor. Thank you so much, Real Talk. I really do appreciate it. Thank you very much. How to stack the odds in your favor, how you use things like asset allocation to make sure that you're risk weighted properly. The investment course goes through all of that. It's available at the moment for $99.99 in Thinkific, which is a private kind of like platform that you can use. You can take it in your own leisure. And if you take it on there as well, you get access to it for the lifetime. If there's any updates, any modules that I add, you get access to that as well. It's got worksheets in there. It's got questionnaires. It's got tests to help you consolidate your knowledge, all that kind of stuff. But what I'm thinking of doing is, as part of the membership, I'm going to have that as a free item for members as well. So you guys can have access to it and just use that to kind of build your knowledge and gain confidence as well. So that will be coming in a few months. Thank you so much, Real Talk again. Daniel, videos on taxes would be good. Capital gains tax with some examples maybe. I could do that. The only thing why I don't do examples like that is because tax rates change. So I could have a look at taxes though. That is one subject that is definitely people have been asking for. So that's something I'll put down, Daniel. Thank you for that. Oh yeah, does HMRC really want one page for each trade? HMRC or HMRC, mate. Like literally, what I would say is this, right? There are certain things that you don't have to declare. So, for example, if you buy shares in Tesla and you sell the shares, you have a capital gain, right? You don't have to declare them you do have to declare them, but you don't have any tax to pay unless you go over your capital gains allowance. So with HMRC, if they ask you for something, mate, just fill it in. They can be very, very like detailed, and they want that detail. But it's HMRC, mate. There's nothing you can do about it. Just, you know, they it is unreasonable sometimes. But you know, I've always looked at it as though just give them what they want, because you just really don't want you don't want that hassle, mate. You really, really don't. 100 pages seems overkill. Yes, it does. But then again, mate, if you've got an accountant can do all this for you as well. So all of my stuff goes via my accountant, or will be going through via my accountant now that I'm fully self-employed. So, you know, but again, if you're not selling these stocks and realizing capital gains, and you're not taking an income, you haven't actually realized any gain for you to be paying taxes. So again, that's worthwhile bearing in mind. Benjamin, thanks for your help. We'll hit you up on IG. Yeah, let's have a talk on IG, Benjamin. But guys, thank you so much for dialing into this one. The next one is going to be in 2 weeks' time. Depending on how these go, I might turn weekly, but that's a bit of a commitment because I've got so many other things going on. So the next one is going to be on the 20th of September. Again, this will be available for everybody to view over the next few days and stuff. But I appreciate you guys being here. I appreciate all the engagement. Appreciate the super stickers. Thank you so much for the support. Thank you. Have a great week, and I'll see you guys on Tuesday. Hang on a second. Was there another one here? The same option for me would be to, like in other countries, initial balance of the tax year 25,000, final balance 76,000, commissions 1,000. There, one page. Yeah, I mean, look, but it sounds like you're going to need an accountant, mate, to do that for you, because I certainly wouldn't want to spend my time filling all that in. Yes, you've got to give them all of the details, but yeah, it's not fun filling that stuff in. So my accountant does and will be doing all of that for me, because that's not something that I want to be dealing with on a yearly basis, depending on obviously what happens there. So, guys, thank you so much. It's now 11:10. Have a great week. I'll see you on Tuesday.